Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to have a slightly long economy show. We didn't do one last week, but we have some key components that we really wanted to talk about, especially in segment one, where we're going to go through or provide an update to the technology shortfalls, what's impacting the supply chains in terms of semiconductors, again on food inflation, what does that mean? And then the impacts to GDP, what is really going to happen to GDP. Then in the following segments, after that, we're going to look at U.S. consumer, U.S. inflation, what is inflation? Because I think at this point, it's like, what is inflation? What is leading in inflation higher? Is the CPI a leading indicator, lagging indicator? Where's PPI? There's a lot of impacts to that in terms of where growth is going to go. Then we're going to talk about Europe and how COVID is impacting some of those data points. And then we're going to pivot to Asia and do a lot on China in terms of what is happening with this tit for tat when we're looking at Chinese geopolitics, where the US comes in, and just what is happening as China continues to try to tighten up or at least limit some of their monetary policy and just try to tighten up some of their issues that we continue to see on the liquidity side. So again, these are things that tie into commodities. So we'll try to link it all together, make it somewhat interesting instead of me just sitting here rambling. But before we get back into segment one, we'd just like to remind you, please like, share, subscribe. That your support is appreciated. So this is just looking at this one specific slide looks at the overview of world economic outlook projections. So this is coming from the IMF staff estimates. So it's just looking at how things have changed. And right now the IMF is actually taking down Europe or the expectations for growth given some of the new data points that came out for March. But realistically, that's not all that surprising when we consider where things are going forward. So the one that we want to look at are the advanced economies to start. So when we look at the difference from January 2021 WEO update or the World Economic Outlook, you can see that there's been a steady increase of about 0.5%. But it's not equal in the sense of what is driving that, because projections continue to move up in terms of where that benefit's going to come from. And it's really being driven by the U.S. And the U.S. is the one driving it really because of the amount of stimulus we're pushing into the market. Because what is the U.S. but the largest importer in the world? So by us stimulating the local consumer, you're inherently going to increase imports. You're going to increase, which will then move into other economies, more specifically China. So there should be some knock-on benefits. Then the issue, which we'll talk about in segment 5 or segment 6 this week, is going to be how, as we shift supply chains, will China see as much of that benefit, or will some other areas within Southeast Asia see that benefit? So those are going to be things to talk about, but we've seen a steady increase in advanced economies. The one that we're seeing a walk back on is obviously the euro area, which is really being driven really across the board, with Italy being the biggest drop. And now they're pushing through another 40 billion euro stimulus. The hope is to try to turn that around. The biggest issue that I have with some of the data points is really when we look at emerging markets and developing economies, because we keep talking about inflation, we keep seeing it come up. Russia actually had a fairly strong bond offering because they did see their interest rates fall. But again, demand was local. It was local banks buying, not international. So it was supported internally, which continues to be some of the bigger issues, especially one that resides in Italy on the advanced economies. But when we look at the emerging markets, India is the one that remains the most concerning in terms of where 2021 projections are. Just given the resurgence of COVID, what does that mean for imports, exports? What does that mean for activity? Which again continues to be a bigger problem when we look at overall growth. Which is why when we look at that world trade volume, when we look at the imports, exports, this is where we think there could be some downside when we consider what is going to happen on the import export. But we'll talk about that more in a few minutes. But when we look at the medium-term GDP loss relative to pre-COVID, it's sizable, and it's not something, and it's something that's going to continue to be an underlying problem when you look at stimulus. China's on the negative side because, again, they're trying to get debt under control. They're trying to pull back some of those loans, which is going to limit stimulus, which is going to hinder some of that expectations. And the U.S. is obviously on the other side of that, pushing through as much as possible, and we'll put that into perspective in segment 2. But then when we look at Asia, ex-China, that's where we continue to see some of those pressures. And as inflation continues to ratchet up, when we look at PPI, export prices, that's going to feed down into some of the pressures, because our 10-year sets how they can borrow, because they really can't borrow at 30 years because of duration risk, but they can at 10 years. And that's why our 10-year continuing to track higher is going to put pressure on their ability to borrow and the amount they can borrow. So there's some of the issues when we look at some of the misleading comments about the IMF growth projections. Is a bounce isn't growth. So we're going to get a bounce. We obviously have a ton of liquidity coming into the market from a fiscal side, specifically the U.S. So that is going to go somewhere. It's just, is it going to be a shot and higher, or is it going to be we have a nice pop and then we fade hard? And even some of their estimates have that fade coming in 2022. When we look at 2021 projections at 6.4%, and then 2022 at 3.5%, the question is going to be, how steep is that decline? And then most GDP upgrades come from higher government spending and higher debt, which is inherently an impact on future growth, especially as we do have interest rates going higher. And then job recoveries in advanced and emerging markets are much slower than GDP upgrades are suggesting, as we continue to talk about when we look at what is happening to the consumer, what is happening to spending, because we are starting to see that slowdown, as we talked about in the EIA show, where the restaurants, came back really strong. They were the biggest driver of job creation, but now we're starting to see some of that, plateau. Some of that goes sideways as we have some additional restrictions, some slowdowns on reopenings, some spots of increasing COVID cases, which again is going to mitigate some of that capacity. And then when we flip over into Europe, we continue to see that pressure. Same with Latin America. And while all of this is happening, we have to consider, and we've written articles about it, and we've talked about this time and time again, the shrinking middle class. The middle class came under the biggest impact due to the COVID in general. And they were already starting to come under pressure, but again, COVID was just the nail in the coffin. So the reduction in estimated combined size of middle class and upper middle classes in 2020, India had a decline of 32%, South Asia 25%, but the developing world was down 7%, which is a total of 134 million people. Now, you might think, okay, 7 billion people in the world, we're talking about 134 million people. The problem is this is spending. This is underlying buyers where if they're not buying, who is? And if they're just changing consumption patterns, that means that trade is going to change. You're not going to see the same movements, or you're not going to see the same margin of stuff moving about, because people are going to go to the cheaper option, which might have slimmer margins instead of the premium. And these spending habits are not going to be short term, which is what we keep talking about when we look at what are the shifts happening in buying. And as prices go up, when does the market reject price increases? And that's the moving target as to how transitory is inflation. Because when you look at PPI, when you look at costs, because how does a company come up what it's going to charge you? It's based on their input costs. How much do the materials cost? How much does labor cost? How much does shipping cost? And then what is their margin on top of that? And then you get what you pay. Now, at some point, you're going to say, I'm not paying that. I don't care if I need it or not. I'm just going to do something else than buy that, or I'm going to buy way less. And then that's where you're going to see the market reject it. But again, we're still at the precipice of the changeover of a lot of these costs coming through, because, and we'll go through this on export prices, import prices, PPI, because it's happening around the world, and it's going to hit the developing world harder and the emerging market world much more than others. And when we think about Mumbai, the largest city in India, getting hit, that again is gonna tie into that middle and upper middle class. So then when we look at the downturn in general, when you look at the estimated changes in the number of people in each income tier, when we look at the percentage change, the poor increased 131%. And when you think about the change in that level, that is where we keep talking about, wage gaps, inequality. And this is, again, not to say that we're going to have a huge civil war in the U.S., but you will have uprisings. You will have riots. We've already started to see them increase in places like Iran and places like Myanmar, other areas within the Middle East, Southeast Asia. We've seen continued protests, even parts of Europe in terms of against lockdowns. This is a bigger problem. And obviously, you can't say that the U.S. isn't seeing it given the issues on the urban level. But again, this is not, the issues are at the top in terms of who's going to be buying, and then obviously who's not going to be buying. And again, this is coming to what are we going to look like on the other side of COVID? So then when we look at the IMF predictions, on an aggregate level, so the forecast, predicts growth in 2021 will be the most since at least 1980. Again, you have a base effect. You have the most stimulus ever to come into the market. So that will aid in the movements. But then what is going to be the impact as, these countries bring more paper to market? Their investors are going to want more for their money. So then that's obviously, that's going to drive up, what the cost of that debt is going to be. So then when we look at manufacturing PMIs, supplier delivery times, we're starting to see some normalcy in terms of month-to-month changes in terms of what things are happening in general and on longer delivery times. But now they're actually starting to get a bit worse again. And it's just this is going to keep PMIs elevated because delivery times are getting longer. But you're also going to try to do things to mitigate and to keep your supply chain, stable and moving in the right direction. So again, this is going to become or increase input costs when you think of PMIs, and how is that going to impact supplier delivery times, which is why when we look at growth upgrades on April versus January, April had a increase, we had increases across the board. Euro area is actually shifting lower now. Based on what has come out recently. So, but the U.S. is one that's going to hold. China is one that's going to hold, and China is going to be one that we think is the most suspect out of the grouping, is because they're continuing to try to tighten. If they actually do it or don't is a completely different topic, which we'll cover in the last segment. But again, the U.S. spike is just obviously driven based on the amount of stimulus we're putting into the market. So then when we look at what is happening on manufacturing PMIs, you're looking on the supply chain managers. So readings of greater than 50%, 50 is again the expansion, but developing PMIs are now outpacing emerging market PMIs. And it comes down to, technically we should see developing PMIs pulling emerging markets higher, but we're not really seeing that. And not to say that we won't, because I think we will get some stabilization in the emerging markets, but we're getting COVID issues, we're getting movement issues, economic issues that are putting a headwind on the manufacturing, because typically developed buys raw materials, semi-finished goods from emerging. And the fact that we're not seeing the same type of growth just means that you're going to see some of the slowdowns in trade. But even though we've seen some increases, which we'll talk about at the end of this specific segment. And then when we look at the historical fiscal retrenchment, when we're talking about the different countries, so the U.S. is obviously the largest. And when we go forward, you're going to have to get a tightness. You're either going to recover it on taxes, which are net negative to growth. You're going to get it on, some sort of slowdown as you start to pull back, which as consumers have less money to spend, they're just going to spend less, or they're going to do more on credit, which is going to, put more weight on them in the longer term. So again, you're going to get this surge and then this drop down as you get this, this fiscal retrenchment, as they're calling it in this specific chart, as you start to get some tightening. And it's a global tightening. This isn't just a U.S. thing, a China thing. This is a global tightening that is going to happen, whether they want it to or not, or they'll be forced to, which again is going to weigh on what that growth looks like. And in the meantime, you have the central banks' balance sheets continuing to surge higher. And I pulled down this chart in April and early, I think last week, and it's already out of date because the U.S. has moved to a high. The European Union has moved back to a high. But again, you're just seeing the trend of additional monetary policy, which is starting to slow at the emerging market level, but clearly at the G10 side, it's continuing to maintain its current pace. And then when you look at the 12-month change, you continue to see how the 12 months where we had some, net small tightening in 2019, which gave way to essentially balanced expansion in 2019, to obviously the surge that we've seen since then, which again is keeping that liquidity in the market. When if we get any type of real growth, then what does that do to velocity money? What does that do to the movement? And then do we start to get this extrapolation of shifts into the market? Because even though there's a ton of liquidity, banks really aren't lending, which is, we have a chart on that we'll talk about when we go when we cover the loan side. So then when we look at the dollar, so the dollar share of global reserves has declined to a 25-year low. So there's always the view that we are the reserve currency, but people are looking to get away from that. And if you look at what the U.S. is doing of trying to paper the market, putting more capacity in, printing more dollars, you're seeing people move away from that a bit. And again, you're not going too far away. You're not straying to the fact that you're going to shift purely to euro or yen or yuan. But you're going to deviate a bit. Does it make sense to have more gold? What does a cryptocurrency look like? Do I need dollars? And this is where we're starting to see some of this friction. So the view that we can continue to paper the town and there's going to be no residual impact, this chart is telling you that we should think differently, and we should start to be a bit more cognizant on how much money are we pushing to the market as the U.S. debt levels continue to surge higher. So then when we look at the world real exports and composite leading indicators, so we continue to see the composite indicators pushing higher. And my pushback is when we look at 94, 95, and we look at some of these surges up, they don't marry perfectly. Like you can get this composite indicator shifting up, but really starting to come back. And the reason why I say that is because the indicators are going to be made up of the PMIs. It's going to be made up on specific structures that are going to be skewed to the upside based on delivery issues, inventory issues. So there's going to be an overshoot on the composite indicators. But with that being said, real exports are still going to go up. There's still that supply chain issue. There's still that shortfall. So we're still going to see this climbing up. It's just as things start to normalize a bit, you're going to see it level off and really not reach the peak, something similar to what we saw in 95 and 96. And then obviously when we look at 09 into 10, you had that big increase, but we didn't have the supply chain impacts that we had today in the same level. So again, these are some of the friction points that we're talking about. And when we talk about friction points, when we talk about the poor and the middle class and people falling out of the middle class into the poor level, you have to talk about food inflation, because food inflation is not going to impact everybody the same. When you look at the nations that have the least amount of food or the least amount of income, you're going to have the biggest impact. And you look at India, which has the second most arable land outside of the U.S., is very impacted based on the GDP per capita is at the lower end of that scale, and food inflation change from a year earlier continues to drive up. It's anywhere from 10% to 60% on whatever calculation you're using on fats and oils versus grains, and those headwinds, if you look at how the U.S. has shifted to actually up as food inflation becomes a much bigger issue. And then when we start looking at like Russia, Turkey, Brazil, and these shifts up into the left, you continue to see the pressure as the per capita people have less money to spend. So as inflation goes up on these key goods, because obviously people will sacrifice anything to eat, you'll also fight to eat. You'll also, riot and raid food storage to eat, which is stuff that we saw happen in Nigeria. And this is just essentially trying to highlight that it's not going to stop. And the food inflation is going to hit emerging markets much harder than it's going to hit advanced economies. But even advanced economies aren't going to get away this time, just because of the inherent shifts that we continue to see with, beans back above $14 right now. So then when we look at countries' potential to recover from COVID-19 and social mobilization risk, this is what we that we talked about in several shows before, in a write-up that we did. The mobilization risk continues to rise. When we look at, what is your ability to move into a different a different class, whether that be promotions, bonuses. The U.S. has actually shifted to the right, which is what we've been talking about. But you still have a certain amount of ability to recover that index. Once we get back on our feet and jobs go up and we get some wage inflation, which again I think will be capped, but we'll talk about that a little bit later again. These are things that we don't have to worry about to the same way. But India, Turkey, Brazil, these are becoming bigger and bigger problems. Nigeria's we've already seen that. But India, China, the Asian continent in general is going to be the one to watch, because it already had friction points before COVID. So this is only going to extrapolate that and make it that much worse. And because again, like as the quote goes, I don't fight because I hate the man in front of me, but because I love those behind me. And I think that's a very powerful statement when you can't eat or food is scarce. And again, this is just, I think, something that's being captured there. So then food is the biggest cost for the poorest, because you'll do anything to eat. So as costs continue to go up, that is going to, that's going to limit how you move people out of the middle class, how you see spending. And as you had more people go into, fall out of the middle class, see their spending get impacted, they're continuing to see the pain moving up and to the left as you get this chart essentially moving, instead of it moving, completely to the right, where you're just actually seeing bubbles moving to the left, up that curve, when we think about right to left. And that's where we keep talking about India, Turkey. Turkey has a huge amount of exposure to the Europe. India is a struggle point when we keep talking about, where does some of that recovery look like and how much stimulus can they do? Because obviously they're going to have to feed their own people there. And a lot of this is also going to result in less exports being in the market, because they're going to try to gate exports to make sure that they can feed their people. Now, some geopolitical update, the U.S. blacklists 7 Chinese supercomputer companies. That is a huge deal, because what does that mean? So we said that we're going to sanction or blacklist 7 Chinese supercomputer companies. Then after that happened, so Thursday's action doesn't fully cut off the Chinese firms from U.S. technology, which differs from the action taken against Huawei technology when the government applied the so-called foreign direct product rule to restrict Huawei's ability to use Taiwan Semiconductor. But it is enough where Taiwan so far has stopped taking new orders from several of the firms. Now, this is not going to sit well with China, and obviously it hasn't, because after this, they then came out and where the U.S. did this, and then we said that we're sending a diplomatic mission of several retired politicians to support or show U.S. support for Taiwanese democracy and our unity and willingness to protect, or at least, in terms of our mutual trade, and how important Taiwan is to us and not just us, but the global supply chain. Now, China is responding by having a live fire drill off of Taiwan while we are there and we're having this high level meeting. Again, this tit for tat that continues to ratchet up, which is why we keep talking about this as a key flashpoint. So the Commerce Department move will not prevent from continuing to source from Taiwan. Taiwan Semiconductor Manufacturing Company has suspended new orders from one of the 7 companies that was placed on the U.S. entity list, with more to come over the next few weeks. Now, what does this mean? Let's look about, we talked about the semiconductor supply chain before, and now we had a new report came out from BCG Analysis, and this just looks at things versus looking at 2019. So when we think of the share by region in terms of the U.S. is still very important for a lot of the viable creation, core IP, things that are logic, memory. But when you look at where is it being invented, but then where is it being assembled, assembly and packaging and testing is very much weighted to China. And that's why, even though a lot of the IP is protected and is kept within the US or within our partners in East Asia, i.e. Taiwan, Vietnam, South Korea, but when we start looking at and expanding that out, we still need to assemble it. And, we've had Apple move away from China into Vietnam and South Korea, trying to diversify some of their supply chains. But we also limit the amount of new R&D and equipment in China because we also don't want them stealing IP, which is what they've been known to do. So again, that's why we don't see this changing as much, which is why China itself is trying to invest in some of these key areas of logic, memory, core IP, because they're trying to drive that change. And they're also trying to, pick up some additional capacity. Now, all types of semiconductors are indispensable in today's economy because it's in everything. And when we think about what is it in, well, where is it in mobile phones, consumer electronics, PCs, ICT infrastructure? Industrial, auto. When we look at that DOAs, or the discrete analog and optoelectronics, because when optoelectronics, you think about screens. Right now, the biggest shortfall is actually in that DAO side of the equation when we look at autos, which is why autos and industrials has the biggest shortfall right now, because we're having trouble catching up. But again, this is not something going away anytime soon, because we have this residual in terms of raw materials, but prices are going up, which means inflation is going to go up, because all of these things are going to come in at higher prices, which will be passed on to the consumer until the consumer rejects it. And I just don't think we're at that point, that pressure point yet. So semiconductor production using a whole bunch of different unique materials and chemicals. So this is why we keep talking about what is being used, what is available in the market, and there are significant shortfalls, or at least delays on the delivery side across many of these assets. When we look at chemicals are being impacted because refiners aren't running at the same level. And that means that feedstock isn't as available, and the feedstock they can get, which is condensate and NGLs, are being priced at a premium, which is hitting in margins, which is pushing up pricing. Then when we look at the COVID and how it shut down the supply chain, we've seen a slowdown and now an increase in cost to get some of these front-end wafer fabrication materials. Again, all of these things are leading to things that we're so used to seeing. Microchips, like think of visuals, memory. We're so used to seeing getting cheaper, and it's just on the opposite side now. Then when we look at what is happening in terms of the industry, the semiconductor industry, value added by activity and region, EDA and core IP, again, 74% is the US. China wants to eat into that component, but China remains the key to it. Same with logic. DAO, memory, in terms on the R&D side. This is R&D, which is very much still driven by the U.S. and her allies, and specifically South Korea, Japan. And then when we look at CapEx and manufacturing, in terms of just intensive manufacturing and then assembly and packaging, 46% is, again, Chinese assembly and packaging. This is something that is becoming a much bigger issue when we think about the U.S. as we have an increase in the trade war rhetoric and saber rattling. We need to get that assembly, packaging, and testing because we have the IP, we have the logic, we have the manufacturing equipment. in hand. We rely on our allies, but again, the assembly becomes the bigger issue, which is why the overall value chain is what China's trying to drive, because the overall value chain, they're saying as of 2019, they had 9%. That is where Xi talks about. That's what the 5-year plan is about, attacking that side, because semiconductor consumption remains elevated in key countries, i.e. US and China. So China wants to create more of its own and be more self-sufficient. So then when we think about, East Asia is home to 3/4 of global chip capacity, which has been shifting over time. And when we look at what is going to happen over the next few years, China continues to invest and build, as we've been talking about, and trying to pick up more of this capacity and become a bigger player, not just into the manufacturing, but the IP creation, and really getting more on the R&D side to become a bigger player in that high margin business versus the assembly, which is a very low margin business. Again, these shifts in terms of R&D IP, that is a much bigger part of the overall Chinese plan, which we'll talk about more in the last segment. But now that we've kind of gone through this, we want to pivot a bit and look at the US and talk more about what's happening to rates, what's happening to inflation, and what does this mean going forward over the next few months.